Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about what's currently happening in the broader markets and just a little bit in terms of the context of the rising rates environment and how that has an effect on equities, as many investors have turned to watching rates pretty much every single day to get a better sense for where equity markets are headed. So we want to talk a little bit about the relationship between the two so investors can understand, not only in the short run, but also in the long run, what our expectations are for equities with respect to rates. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with an update on just broadly, what is the relationship between yields and the broader equity markets? What a lot of investors have learned over the past few weeks, the past maybe month or so, is really that inverse correlation between yields and equities. As yields rise, equities have declined. At least the high beta tech stocks have declined. So we want to talk a little bit about this relationship, especially over the long run, what that relationship looks like, what the statistics show us with respect to in a rising yield environment, how do equities typically react to it. So then once we understand that, we'll then take a look at the broader market updates, where we currently sit within the major indices, what our views on each of those indices are. We'll take a look at sector rotation, which sectors are moving within the S&P 500, where we're seeing strength, where we're seeing lagging sectors. And then we'll take a look at rates and commodities as rates has driven a lot of the equity market volatility, where that currently sits and what our expectations for that commodities as well, and then share with you a few of our ideas before we open this up here for a few questions here at the very end. So the primary question that we want to help investors answer from today's session is, can equities rally as rates continue to rise? That's the primary question that I think many investors currently have in their in their portfolios as they see yields climb. They're concerned, whether or not they should continue to stay in equities or not. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical research, my economic research, my statistical research that helps inform my decisions in the broader markets. So let's first take a look at the relationship of yields versus the S&P 500. So what I have here first is a list of every single major move in the 10-year yield over the last roughly 100 years. And as you can see, over all of these time periods, the average down cycle in 10-year yields lasted roughly about 3 years or so. So the average down cycle of 10-year yields is about 3 years. And during that time, it moved an average of about 2.58% lower in terms of yield. So the 10-year yield, on average moves about three years to the downside, about 2.5% in terms of changes in yield. And during downtrends, okay, so when yields move lower, on average, the S&P 500 moves higher. Now, this is a relationship that we're familiar with. During that time, the average move in the S&P 500 was about 31% change in the S&P 500. So that's really where you can see the strong relationship between when yields decline and in returns here for the S&P 500. Now, what's interestingly enough is that when yields decline, 89% of the time, the S&P 500 rose in value. And that average rise was about 31%. So we're talking about fairly long periods of moves down in rates causes fairly significant returns in the S&P 500. So the question now becomes, what happens in the exact opposite scenario? So when yields rise, what are the returns for S&P 500? A lot of investors expect that when yields rise, S&P 500 returns are negative, but that's not what we see. So what we see here on the other side, when yields rise, so these are the periods of time when 10-year yields rise. First of all, the average duration of that is about 2.3 years, and the average move up in 10-year yields is about 2.36%. So before we're looking at about 3 years and down about 2.5%. Now we're looking at just a little under 2.5 years where the rates rise about 2.5%. During that time, the average S&P 500 return, 13%. So still positive, not as positive as when yields decline, which is expected, but still fairly positive. So the average move in the S&P 500 during a rise in rates is still positive. And encouragingly enough, also 73% of the time when yields are rising, the S&P 500 also rises as well. So the data clearly shows us that yes, the relationship is that when yields decline, S&P 500 will rally significantly, but when yields decline, S&P 500 will rally significantly, but when yields rise, the S&P 500 still, for the most part, rallies. It just rallies not as strongly. So that's the environment that we're currently trading in, is that we're in a relatively young rate cycle. So far, we're only about about half a year in on an average move of about 2.3 years in terms of duration. So far, this change in yields have been less than 1%, where the average is about 2.36%. And so far, the S&P 500 is already up 16%. So that just puts it into context into what we're expecting. And keep in mind that there's been plenty of times where the moves have been well in excess of 40%. So this is what we're currently experiencing is nothing out of the norm. So just because we have this rising rates environment does not necessarily mean that the S&P 500 has to move lower. So that just puts things into context for those of you looking at the bigger picture, especially for those of you that are longer term investors. So let's take a look at the S&P 500. We've had a continued strong move to the upside on the weekly chart here. On the daily chart, we continue to see this momentum shift where as we made higher highs and momentum no longer confirmed those higher highs, we have now had a bit of a pullback here, but so far the 21-day moving average is still holding here for the S&P 500. Now, I will say that the fact that we have failed to break out above this recent all-time high here is concerning, that this is more of a sideways neutral move here for the S&P 500 unless we can break back above this level and continue moving higher. For now, I am much more in a neutral view here for the S&P 500. For the QQQ, the NASDAQ 100 index, what's concerning to me is the fact that we failed to break above 324. So we had the significant pullback here over the past couple of weeks. 324 was a major resistance level during the initial sell-off here, sold off all the way down to 295, rallied up to 294 and failed again at that level. And the fact that we have failed to break out above that level and we continue to make lower highs is concerning to me, that this is likely heading back down to perhaps 296. So that's where we currently sit here in the S&P 500 versus NASDAQ 100. The S&P 500 looking fairly neutral, the NASDAQ 100 looking mildly bearish here at the current moment. Unless it can hold on to this 21-day moving average, break above 324, then we would put ourselves back into more of a neutral zone for the NASDAQ 100. And if it could break back above the 338 highs, then we would get back into a bullish tone here. But at the current market environment, that does seem less likely. But over the next few weeks, as things, especially as the decline in COVID cases, the acceleration in vaccine news, and the reopening trade continue to take hold here, that is possible that we get that in the next few weeks. But those are the things that we need to see. Those are the types of developments that we need to see for equity markets to resume that bullish view here. And then when we put that into context, if we look at the Russell 2000, the IWM, very similar chart to the S&P 500, failing to break above that all-time high here back in early February, failing that level, but so far holding that 21-day moving average. So certainly, again, also very neutral. At least it's making higher lows, higher highs, and it continues to continue onto this grind higher here. But again, if it breaks below that 21-day moving average, this looks like more of a neutral zone rather than a bullish view just at the moment, unless we can break back above that 235 level and continue to move higher here. But momentum, there is some concerns here with momentum, as you can see, as we made higher highs. Momentum did not confirm those higher highs. We do have some higher lows here, which could potentially start the next leg higher here, but that's what we're currently watching. Until it breaks above those all-time highs, this is not quite bullish yet. And then the RSP, the equal weight S&P 500, this is the only one that's managed to hold on to those February highs. So actually breaking out above, pulling back to those levels, holding these levels, and potentially continuing higher here. So this is the one segment of the market that really leads me to believe that market breadth is still fairly strong, that the markets are still holding on to these gains, and fairly strong here because the equal weight index actually performing better than the market cap index, even though we saw a little bit of that shift here yesterday. But one day does not make a trend. But overall, the RSP holding those prior highs is fairly strong here for equity markets to ultimately resume this bullish trend. Also, if we look at the VIX here, the VIX is now back below 20% here. This is effectively the post-pandemic all-time lows. So since the start of the pandemic, the VIX have never been this low before. This is significant because this really gets you to start thinking about, are things starting to return back to normal? And this is certainly one indicator that points us to, starting to get back to normal, especially as the vaccine rollouts continue to accelerate. The COVID numbers continue to look fairly strong, especially models that look out 90 days are looking fairly strong here. So those are the things that we're looking at. But the main thing in terms of equities that most investors are currently looking at is this shift between value to growth. We've been talking about this underperformance of value to growth for a long period of time. And then we've had this bottoming formation here from value to growth. And recently, this outperformance of value to growth. And this is the zoomed in chart here where the value finally broke out above this bottoming formation, accelerated it to the upside. But over the past few weeks have failed to continue to gain momentum here, has really moderated a bit. So this is one we're still paying attention to. The 62-65 is really the ratio that we're paying attention to. If we break below this, that puts growth back into the driver's seat here. A break above 65, that puts value back into the driver's seat. It's been moderating here over the past couple of weeks. This is one that we're watching very heavily. If we look at the economics and look at where we currently are in the recovery cycle of, coming out of recession, this certainly puts value potentially into the driver's seat. And the main level that we're paying attention to here, again, is this 0.65 level here. If we break back above it, this certainly would put this full bottoming formation completing, and then an actual rise in terms of our outperformance, if you will, of value versus growth. But we haven't seen that breakout just yet, but this is one that we're watching. But the fundamentals certainly favor an outperformance here of value versus growth during this, where we currently are in the recovery cycle. So taking a look at sector rotation, this is where, again, this is the 21-day rotation, so what we've seen over the past 21 trading days. And as you can see here, in the weakening category, we have energy continuing to weaken here over the past roughly 10 trading days, a fairly substantial weakening. Same thing for financials, substantial weakening here, especially as rates moderated a bit here over the past few weeks. The past few days. And then we have industrials and materials also starting to get into the weakening category with communications, while slowly looking like it was going to rotate higher here, has failed to actually get back into the leading category here. But communications remains one of the stronger names here in stronger sectors. And if we look at the strengthening sectors, we really have real estate, which has actually continued to gain ground here over the past few trading days. Utilities, which started to lead but starting to fall back behind a little. Same thing with staples, was leading but starting to fall back behind. And then we have consumer discretionary really coming up strong here. Consumer discretionary continuing to strengthen and improving, and potentially getting into the leading category. Not quite there yet. And then we have healthcare. Healthcare starting to get stronger here, but starting to fail a little bit. And then technology coming up from that lagging category, starting to get into that improving category. So technology, not quite there yet, but certainly starting to come back to life here. So really some of the ones that I think worth paying attention to are real estate, just got into the leading category, consumer discretionary, starting to get into that leading category, and potentially technology continuing to strengthen here. So, when we're looking at sectors here, shifting a little bit away from energy away from financials, industrials, and materials, getting back into consumer discretionary, into real estate, into technology. Those are some of the sectors that I think are worth paying attention to here in the current market rally that we're seeing. So if we look at the 10-year rates, the 10-year have basically moderated around the 60 basis point level since late February, early March. We've had that move to the upside, move to the downside, move to the upside, and we're back down close to around 164 basis points right now. But if you look at the long term here, we've broken above this 155 level, which had been a major support and resistance level prior to the pandemic. We've gotten back above it. We've broken above it, coming back to perhaps test this level as support, and then potentially rising up to that 195, 185, 190 level here, which happens to be another resistance level that we've seen here in rates prior to the pandemic. So that's where we're currently looking at here from a rates perspective. And then you look at the dollar index. Dollar index also looking like it's about to complete a major bottoming formation here after a long underperformance here. It's completed what looks like a bit of a bottoming formation here. A little bit of a bottoming formation here. It hasn't quite broken out from this 92.5, 93 resistance level. As you can see, this is still acting as resistance here in the current moment. But the question is whether or not dollar can now break out higher here. Certainly starting to make the formations of what looks like could be a breakout here, but not quite there just yet, on the verge of that. So that's one we're paying attention to, which has ramifications on gold, on silver, on crude. So taking a look at that, the strong move that we've seen in dollar has really put a bit of a dent here in some of the commodity prices like oil. We've been talking about this exhaustion in oil for quite a few weeks, as oil continued to make higher highs. Notice how momentum started to move lower. That was our warning signal of this big move to the downside. We got that big correction here over a single day. It tried to bounce higher to the 21-day moving average, but failed again here. So this is more likely going to be a bit of a range bound here for oil around the $60 level that we're expecting to see here going forward. That's going to put a cap here on the XLE rally, and we're likely going to see XLE start to underperform, as we saw in that sector rotation model that energy has continued to underperform here. Same thing here for gold. Gold has rebounded a little bit here, but still well below the 21-day moving average, which, as you can see, consistently provides resistance here. The question is whether it breaks out higher above that 21-day moving average or gets rejected and starts to move lower here. If dollar continues to move higher here, this certainly would favor more of gold moving lower here at the moment. But right now, gold continuing in this kind of downward trajectory here at the moment for gold. Now, shifting over to some trade ideas. This is really where we have to look again, looking at where we are in the cycle, looking at the fact that we're in this recovery cycle, recovery phase of the economic recovery. Where do you look for opportunities? And in that cycle, it's not the high growth tech names that you look for recovery or look for performance, really in the more cyclical names. And that's why we prefer, again, to play more defense here in this particular market environment that we're in, and shift more towards value than we are towards growth. So some of the plays that we're looking for, are looking at that is Walgreens. Walgreens has been a long underperformer here in the broader markets, even through the pandemic, has largely underperformed here. But recently, forming this forming some breakouts here above this 47.5 resistance level here. You can draw these lines different ways, but we've broken above some major resistance level. And now if we zoom in here on the chart here, you've had this $52 level here that has rallied multiple times to this level, finally broke out, came back to retest this level as support. And the support or resistance, or I'm sorry, the risk reward here certainly favors to the long side here for a name like Walgreens, because a break back into the $50 zone would warrant cutting losses. That's about $3 of risk, and then you have potentially far more upside here into the $60, 200 week moving average, and also that recent high here from there. So you're looking at about $7 in upside with about $3 in downside here. So the risk to reward ratio certainly favors looking at something like Walgreens. Another one that we want to pay attention to is some of the banks. The banks continue to outperform here. You know, we've seen a bit of a slowdown here in terms of financials, but still XLF outperforming the S&P 500 as the S&P 500 has pulled back here over the past few days. Banks continue to move higher here. And the fact that we've had the pullback here to the 21-day moving average is the opportunity that I see for continuation here, especially as banks continue to show that, especially in the rising rates environment that we're currently in, and when we look at the banks, the slowdown in momentum that we've seen in the banks, in my opinion, actually presents the opportunity, and the valuations across the board and all of these major banks right now are fairly inexpensive. So when we're looking at the broad spectrum of valuations here, financials still rank one of the lowest in terms of valuations. So when you're looking for an economic recovery and you're looking for opportunities, the financials still provide quite a bit of value, and that cyclical momentum play here for recovery. This is really where banks sit at that intersection between the cyclical recovery and relatively cheaper valuations. So you can look at Goldman Sachs, you can look at Citigroup, you can look at Bank of America. All of these names are suitable here for this recovery play, playing more defense using some of the financial names rather than these high-tech growth names or high beta growth names, which is where we expect to see quite a bit of weakness here, as we've seen in that the NASDAQ 100. Same thing here for Citigroup. I do think that the charts here for Citigroup actually look slightly more favorable. We've had that recently. Big move here to the upside to $70, a huge pullback, and finally a breakout higher. But now we've pulled back a little to that 21-day moving average. So again, very similar setup to Bank of America, where the risk to reward ratio simply favors here to the upside. You have resistance here in the $80 level. So you're looking about another $8 higher here to that resistance level. But if it gets back into the $66 level, we would cut our losses. So you're looking at just about $3-4 worth of downside and looking about $8 here to the upside. So again, risk to reward favoring the long side here for some of the banks. Another one that may not be on your radar are REITs, XLRE. As I was showing you, real estate really coming up in terms of sector rotation. This is one of the sectors that many investors have not seen outperform, and is not on most investors' radar. But and many investors felt that real estate was going to be the one sector that was going to fall apart here in 2020 and into 2021 as the economic recovery as economics collapsed here last year. But we've really seen a resurgence here in real estate, and specifically when we look within real estate, there is a pretty wide spectrum of different types of REITs. And ProLogis, which is one of the largest warehouse and logistics real estate companies, has really done fairly well, has done incredibly well during the pandemic, because they are largely allowing e-commerce and companies like Amazon and e-commerce stores to build out their warehouses and continue to grow their businesses online. So this is one area of real estate that has largely weathered the economic recovery fairly well and is likely going to do well going forward here. So this is one that we're paying attention to here. Currently not particularly overvalued here, currently still trading within a trading range, has not broken out just yet. So looking for that upside and a potential breakout here. It's currently in the middle of this trading range. So the risk to reward ratio, in my opinion, isn't that favorable, but this is where I would prefer to use options to play this to limit my risk to the downside and look for that potential breakout here above 108 here to the upside. So with that, that covers what I wanted to share with you here for today in terms of how I'm viewing the markets. Like I said, in this rising rates environment, the markets certainly are not as bullish, but they are still quite bullish within that rising rates environment. It's not a reason to not go long the markets. And you have still plenty of defensive cyclical plays that you can play here. As I showed you on the sector rotation model, there's plenty of rotation going on underneath a market that looks like it's not moving very much. If you just look at the S&P 500, you'd think that the markets are not moving very much, but within the sectors, there's quite a bit of movement. That's the opportunity that you want to see in this type of more neutral view that we have here in the broader markets. So, and at the moment, it favors more of those cyclical sectors, consumer staples, consumer real estate, consumer discretionary, and then we've seen that decrease in relative strength in energy and financials and some of the materials and industrials. But, technology is starting to come back a little. We're not quite there yet, but those are some opportunities that you can also see here in the broader markets. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.